Today's episode is about order to cash process, the sell side mirror of the purchase to pay process. So order to cash is the end-to-end process from a customer placing an order to you collecting and booking the cash. In a way, it's the exact mirror of purchase to pay. P2P is the buy side, you order from a supplier and pay them. O2C is the sell side. The customer orders from you, you fulfill the invoice and collect money in. So it's exactly the mirror of P2P. So O2C starts at order received, and ends at cash collected and applied. Upstream of the order, the quote, the lead, configure price quote, that's quote to cash and lead to cash. So these are wider scopes, not for this episode. The back half, invoice to cash, is what we call accounts receivable. Accounts receivable is the back half of O2C, exactly like accounts payable was the back half of P2P. We talk about it here a little bit, but it will earn its deep dive later on. We're taking the same example but reversed. This time we are the ones doing the sales compared to last episode. And the idea here is that we are a laptop manufacturer and we are selling laptops at 50 laptops at the price of 800 euros each. So that's a total for 40,000 euros. So we start with the customer placing the order. We enter it in SAP transaction code. This is the code. It's it's VA01. What happens is that it's writing the header and line items, and it's the first activity in our process for order to cash. Also, the case ID is allocated here. So a case ID is allocated here. Now, the question that is asked is, can we actually fulfill the order? That's what ATP stands for, availability to promise. The system is going to check the stock and it tells you whether 50 laptops, in our example, the 50 laptops are on hand and when they can be shipped or not. If yes, you confirm the delivery date. So the conceptual heart of O2C is the control gate. Before committing the goods, the system runs a credit check, and this happens against the customer's credit limits and their current exposure. Meaning, in layman terms, this is what they already owe plus the open orders. Then, if the order keeps them within the limits, it proceeds, we commit the goods, there is no issue. On the other hand, if it pushes them over or their risk category flags them, the order is blocked. What happens then? You have a credit hold, so the order sits until a credit analyst manually releases it. This has actually code of its own, it's VKM3, and in a way, this is the main block gate of O2C. It's, if you remember the P2P video, we had the three-way match. So this is the same, but from the other side. One final thing, if you remember our example, our customer already owed, let's say our customer already owed 380,000, and you have a limit of 400,000. The order of 40K would take them over 420K. So here we have a credit block, and the laptops do not move until someone releases them manually. So after clearing the gates, what happens is that we have all of this info that gets sent to the customer back. And that's the step of order confirmation. After that, we have fulfillment. So we create a delivery, and we have our own code as usual. So this generates the delivery document. Then the warehouse picks the 50 laptops, packs them, and on your log, if you watch your log, you would find create delivery, pick, pack. You would find them on your trace, of course. So here, you don't really need to remember the names of the tables. You can find them anywhere on the internet by a very simple search. Now the goods leave the building. You have what we call a post-goods issue. So the moment the goods leave the building, you have the inventory that's going to drop, and you have the cost of goods sold that's posted. It's added to your accounts, of course. Now you invoice, so you create the billing document. You have the transaction that has the following code, and the invoice goes to the customer. This means that you post 40,000 as an open receivable. The invoice will be sitting as an open accounts receivable item. So the customer pays, the incoming payment is posted, and cash application clears the open item. So we match the 40,000 received against the 40,000 invoiced. If everything is clear, the case is done. It means cash is collected and applied. And then this is the end of our process. The receivable moves from, you have the BS, this is the open part, and it goes to BSAD. Until now, I've been presenting to you our happy path. So you have all of these events, and we go one by one through them. The issue is that if you look at real data, this almost never happens. So one issue with O2C is that you have order, for example, here, and you don't know which should be your case. It's not very obvious because an order has many deliveries, and each delivery has many invoices. And let's say your case ID was the invoices or the delivery. Each one of these is a valid case ID or subject of analysis, lens of analysis we have. And if we go with classical process mining, this can create problems. For example, conversions and diversions. And also, if you go with classical process mining, you're not considering data that's not belonging to your case ID. So these problems we have already discussed in other videos, for example, the ones about OCEL 2.0. And you can see an explanation about conversions and diversions. But generally, O2C benefits a lot if we go to the object-centric process mining lens. OCPM. Let me write it here. OCPM. So what can we mine in O2C? First of all, we have created block delays. This happens when our order is sitting for 4 days and revenue and cash are being frozen and not being used. So we can solve that. Then we can solve the ship before approval issue. So this happens when you have goods leaving the building before finance cleared. So we have a control bypass here, control bypass. This is caught as an ordering violation, of course, and we can avoid the two. Then we have order change rework. So this happens when you have, every time you have a quantity or an attribute that's being bumped, you are retriggering a credit check each time, which loses you a lot of time and friction. Then you have the slow cash issue. So if you have invoiced at day 0 and paid at day 52, that gap across the whole receivable books is our DSO. So mining shows which segment or terms are dragging it to be so late. Finally, one thing that there was a project from Siemens, and Siemens found 923,000 variants, which is variance explosion. This is what it's called. And this means that there is no single happy path to mine over it. But the lesson is holding here. The fact that there is no single happy path is the point of why we need process mining. Now to recap, we have seen how the template for O2C looks like. So this is the template. Of course, there are many different possibilities and variants, but this is the happy path, or maybe the template, let's say it that way. Then also we have seen the difference between O2C and P2P. And we have seen that O2C is sort of the mirror of P2P. Next video will be about agentic AI. So if you like these videos, please like and subscribe and follow me on LinkedIn.